Okay, we are starting now.
Listos.
Good afternoon, everyone. It's a pleasure to have you here in this event, our first conversatory in English. That is a special occasion since the topic is an extremely technical topic and deals with international matters. Therefore, we consider to try to bring the best for you. So, and for that, we thought it was the best to have this conference in English. The organizers are the Fundación Aguirre Anguiano, Azuela, Chávez Jauregui, Pro Derechos Humanos, the magazine Tiempo de Derechos, the director is here with us, Dr. Rafael Estrada, also the Vienna Austrian International Tax Institute, where Rafael Petrucci is the managing director of the Transfer Pricing Center, and also we have Marisol Oregel, that is part of the Ibero-American Transfer Pricing Institute. So we welcome you here. As I said, this is our international conversatory for this month. So without any further introduction, let me introduce the speakers today. First of all, we have Marisol Oregel from Mexico. She's the regional transfer pricing leader from RSM Latam. She's the national leader in transfer pricing practice. She's based in Chihuahua, in the office in Chihuahua. She leads the Mexican transfer pricing practice with over 20 years of experience providing advisement on the subject for large and middle market multinational companies operating in diverse sectors in Mexico, Central and South America. Marisol has participated in several engagements for companies of different sizes of multinational groups. Her experience includes assessments and guidance on transfer pricing and COVID-19 implications, advice for multinational companies in BEPS matters, transfer pricing for the following sectors: aquaculture, aerospace, agriculture, automotive, chemicals, recycling, consumer goods, entertainment, food, beverage, footwear, hotel, maquilar, real estate, telecom, transportation, among others. Advanced pricing agreements, APAs, transfer pricing risk management, and implementation of the benefits of treaties to avoid double taxation. As we also mentioned, she is the Transfer Pricing National Technical Committee. She's founder member of the Asociación Iberoamericana de Especialistas en Precios de Transferencia, who is the co-hoster of this event. And she's authorized to act as an expert before the bodies of the judicial branch. Marisol, it's a privilege to have you here with us. You are our expert for the Mexican perspective, so we are very happy that you accept this invitation and you are so kind to share your knowledge and your vast experience with us. And also, we have here Dr. Rafael Petrucci. He's the managing director of the BU Transfer Pricing Center at the Institute for Austrian and International Tax Law at BU. BU is the Vienna University of Economics and Business, and he's also international tax advisor specializing in international tax and transfer pricing at Baker & McKenzie. Rafael has gained extensive experience in dealing with topics related to international tax and transfer pricing for many years, both from a professional and academic perspective. He's a frequent speaker in international conferences, a lecturer of numerous courses all over the world, as well as an author of many publications. Finally, among others, he is a member of the United Nations Subcommittee of Transfer Pricing, of the International Fiscal Association, and of Transfer Pricing Economies for Development. Rafael holds a PhD in International Business Taxation at BU, an LLM in International Tax Law at BU, and an MS in Business Administration in Law at Bocconi University from Italy. It's also a privilege to have you with us, Dr. Petrucci. We know you are you have your hands full of projects, so we really appreciate that you gave us a space in your busy timing. Welcome both of you. So now let you explain how this is going to work. First, Dr. Petrucci is going to give us an overall experience of the transfer pricing issues around the world. Professor Marisol will intervene when she considers it necessary. And after he finished his presentation, Marisol is going to share her perspective from the Mexican side. After that, this is scheduled for 1 hour exercise. After that, we will have 20 minutes of questions and answers from the public. Just feel free to share it in the chat, or also you can, there is a question and answer section where you can write down your question. And with no more further introduction, welcome all of you. Welcome Dr. Estrada again. So we leave the word to Dr. Petrucci. Please go ahead.
So, muchas gracias, César. Y buenos días a todos. This is my Spanish, the best that it gets. So I hope we can continue in English. So happy to be here. The idea for this 20 minutes is basically to start discussing what are the developments on transfer pricing around the world, what is going on, what has happened in the past years, and what can we expect for the future years. And as already mentioned, please, Marisol, Alejandro, Cesar, sorry, and anyone in the audience, if you have questions, feel free to interrupt and ask. I'm here to to present these topics in hopefully an interactive way. So what's going on around the world on transfer pricing? First of all, let's look at what has happened after BEPS. Of course, BEPS has changed a lot in international tax, and transfer pricing was one of the main drivers of BEPS. Probably 1/3 or even more of the project was dedicated to transfer pricing. So what has BEPS changed when we talked about transfer pricing? First of all, I think one of the main achievements of BEPS has been a behavioral change. So BEPS has changed behavior when it comes to transfer pricing in a way that has for sure raised awareness on these topics. Probably before BEPS, of course, transfer pricing was already there as a topic for many countries around the world, but not too many tax administrations and taxpayers were paying considerable attention in most of the countries, with the exception of few countries, but most of countries started becoming aware of these issues during BEPS. So for sure, this is something that is a huge outcome of BEPS when it comes to transfer pricing. What we've seen, because there is more awareness, is also that there is more audits. There are audits around the world more and more on transfer pricing. Transfer pricing comes as a topic in nearly every audit. And when I talk to people working in multinationals, they often tell me they're mostly working on transfer pricing and VAT. Those are the main issues on their tables nowadays. So this is for sure something that is an outcome also of the discussions had during the BEPS project. More guidance. You see here two books that have been updated after BEPS. So you see the OECD guidance on transfer pricing issued in 2017, and soon, hopefully, we will have a new version of the book, including a new chapter on financing, and the UN practical manual on transfer pricing. This one you can actually freely download it online and was updated in 2021. So there is more and more guidance on these topics as an outcome of BEPS. Of course, all this is ending up in having also more disputes on transfer pricing. We will see the situation specifically in Europe in a couple of slides, but there are more and more court cases on transfer pricing, since that neither taxpayers nor tax administrations are shy anymore to go into disputes at the court level. So this is something that is changing a lot. And for sure, there are more discussions on these topics, and this is an outcome also of BEPS. Another outcome of BEPS is that we have more discussions on more complex issues. So if before BEPS, when we're talking about transfer pricing, we're often dealing with issues related to the mere pricing of a transaction. So the profitability of a transaction, the price of an exchange of products or services between different companies. Now we have more discussions on more complex issues. First of all, there are more discussions on the delineation and recognition of transaction, typically whether a transaction makes sense, whether there is enough substance in the transaction, and not substance in the way that basically other areas of tax law intend substance to be, but more on functions, assets, and risks. So whether a third party would have agreed on similar transactions, and whether the contractual terms and conditions agreed between related parties are something that third parties would have agreed upon. So transfer pricing is becoming more and more not only an economic exercise, but also very much of a legal exercise. So this is for sure something that has changed. We have more discussions on financial transactions. The OECD and the UN have been working significantly on these topics. Those were transactions that in the past were not really much looked into because tax administrations and taxpayers were thinking they are too complex to deal with. They require special knowledge on corporate finance issues, for example, and so it's not easy to deal with these types of transactions. So in the past, they were not looked into, but there's more and more discussions on these transactions. Intangibles, this is another big topic. Again, this is a topic that was often disregarded in the past because it was considered to be too complex to deal with. But thanks to the relevant discussions to the BEPS project and the new guidance that we have in Chapter 6, intangibles have become a big issue in the discussions between taxpayers and tax administrations. Business restructurings. This is something that is coming more and more and will come more and more in the future. When you move people, when you move functions, when you move risks, even from one country to another, from one entity of the group to another, then there is a huge risk that tax administrations will complain or will somehow assess the existence of a business restructuring and impose some exit taxes related to that. And this is, of course, in a period like the one that we are living, where companies are constantly changing, they are restructuring their supply chains. This is an issue that is coming and will come more and more, also as an outcome of more mobility of people around the world and more ability to, sorry, I lost it for a second. Okay, ability to work from wherever they want in some cases. Last but not least, the OECD is also looking into amending the guidance and the commentary to Article 9. This is something that is still not completed, but is an outcome of the BEPS work on financial transactions. So we will see how that guidance is going to change in the future. I don't know if there are any questions on what I'm talking. I will go ahead and assume there are not, but please feel free to ask. Also, more compliance. This is for sure another outcome of the BEPS project. So BEPS said, in order to deal with transfer pricing issues, you have to have your compliance in order. You have to have ready a master file, a local file, and a country-by-country reporting. Those are something that you might be familiar with. So the master file is typically a document that describes the overall transfer pricing policy of a group. The local file looks into the specific transactions that every entity in a country is having with related parties around the world. The country-by-country reporting is not really much of a transfer pricing document, although it was suggested, as was conceived in the work of the OECD within BEPS Action 13 related to transfer pricing documentation, but the country-by-country reporting is more trying to provide an overview of a group key financials, and they don't derive from a transactional approach as a transfer pricing tries to do, but they look at more general numbers like revenues in a country, number of people that you have in a country, and taxes that you pay in those countries. Country by country is something that was discussed at length, but so far, based on my discussions with taxpayers and tax administrations, is something that has yet not led to a lot of audits in this area. And is a document that most probably soon will become public in Europe. So Europe is working on a directive on public country-by-country reporting. We will see what the outcome of this is. To be honest, I'm not really sure that having public country-by-country reporting is something beneficial, neither to taxpayers nor to tax administrations, but this is the direction we are going to, and probably we will see more and more articles in the news on the outcome of the country-by-country reporting. So a quick look on what is happening in Europe when it comes to transfer pricing case law. I have prepared some statistics in order to provide you with an overview of what is happening in Europe on this. First of all, looking at the countries that are having more transfer pricing cases, you see the Nordic countries, Denmark, Finland, Norway, Sweden, are the ones that are more active when it comes to case law on transfer pricing, so litigations in courts on transfer pricing. You see countries like Poland and Italy as well. They are really litigious countries where tax administrations are quite aggressive and they don't give up easily on transfer pricing topics, and that's why often there are transfer pricing cases. You see big countries like Germany, Spain, and France, of course, but they have not been having too many court cases, Netherlands and Belgium as well. So these are the countries where in the last couple of years, we have been having most transfer pricing cases in Europe.
This case, Professor, sorry, I have a question.
Sure.
When you have these cases, these statistics are about local cases or cases before the ECJ or another international court?
Those are all cases at the local level. So this is when a tax administration is fighting with the taxpayer at the local level. We will see in a little bit also some state aid cases that are more at the European level. What types of transactions are there in the discussions? Financing seems to be here a big topic, as I mentioned before. As an outcome of BEPS, financing is a big issue in Europe. So most of cases are about financing. And intangibles. So this confirms what I was saying before about BEPS. There is more and more discussions on these two topics that in the past were perceived to be quite complex and not that many tax administrations wanted to go into. Goods and services, of course, the typical discussions here are also in the core of some court cases, and business restructurings, as I mentioned before, are also coming more and more into the discussions. Interesting enough, when we look at what type of issues are there in a transfer pricing analysis, as I mentioned in the past, most of the discussions were about selection and application of transfer pricing methods. So the numbers, the economic analysis of transactions, the profitability, the margins that you apply, whether you locate in a specific part of a range of results and so forth. But what is more interesting to me is that nearly 40% of those cases are not about those economic issues, are more about legal issues on substance and reasoning of a transaction. And this is something that is coming more and more. So more of the discussions that will come in the future between taxpayers and tax administrations will be on these legal aspects as well. Looking at what other issues you have there in the discussions, documentation, as I mentioned before, compliance is a big issue, and documentation is coming more as an issue. Loss making, so when you have losses in a company, of course, you have a lot of discussions with tax administrations. Permanent establishments, burden of proof, the interplay between transfer pricing and general avoidance rules is also an interesting development. Recently, there was a case in the UK, BlackRock, where the court preferred to solve the case using transfer pricing rather than general avoidance rules. And also retroactive application of the transfer pricing guidance. This is also quite interesting. When you look at the court levels of these discussions, most of those are at the highest court. So this shows that taxpayers and tax administrations are not willing to give up on those cases, and they continue fighting until they reach the highest court level. Cesar, I see your hand raised. Is it because of the previous question, or you have a new question? Okay. So most of the court cases are happening at the highest level, or ended up in the highest Supreme Court level, which shows again that taxpayers and tax administrations don't want to give up on this fighting. When you look who is winning, surprisingly, tax administrations are winning a little bit more than taxpayers. And again, this is the demonstration that BEPS has changed the rules of the game. And while taxpayers before had a lot of tools in order to circumvent, in order to somehow win all these cases, now tax administrations, because of the developments during BEPS, have a lot of tools in order to challenge taxpayers. Look at what is happening, for example, in the US. The IRS for many years has never been able to win a transfer pricing case with taxpayers. And now you see big cases like Coca-Cola, where tax administrations have been having big wins against the taxpayers. And this probably is an outcome, again, of BEPS. State aid, so these are the more European cases where the European Commission has been complaining about some practices of some countries when it comes to rulings concerning transfer pricing. The Commission so far has been winning a case against Belgium on excessive profit tax regimes. This is the only case so far that has been reaching the ECJ, the court. However, it's not yet closed as a case. The other cases have been decided only by the first instance court in Europe. And the Commission has been winning the case with Fiat and has lost the cases with Amazon, Apple, and Starbucks. So what is the future ahead? What can we expect to happen on transfer pricing in the future? First of all, there are and there will be more and more developments on dispute avoidance, on discussions and resolution of disputes between tax administrations and taxpayers before reaching any dispute, any double taxation. So we see more and more tax administrations that are willing to go into APAs, advanced pricing agreements, and rulings in general. So this is coming more and more and will come more in the future. In Europe, we have interesting developments on so-called joint audits or simultaneous tax examinations. So tax administrations are cooperating cross-border in order to make audits. And this means that a taxpayer during a joint audit can be reviewed by more than one tax administration at the same time. This is a positive development for a taxpayer in general, because in transfer pricing, it's extremely important that tax administrations reach a common understanding of the transactions. So if they have the chance to discuss those in advance when they are still in the audit phase, then is for sure something that taxpayers will benefit in the future. And cooperative compliance programs. You have ICAP is something that the OECD is working for many years now, where taxpayers and tax administrations of many countries can gather in the same room, and tax administrations can ask all the questions that they want to the taxpayer in advance before having any tax audit. This is for sure a positive development that will be more and more important. In Europe, we have a specific program that we are starting developing a couple of weeks ago. We have been having some news on this. It's called Ithaca, and it's a specific cooperative compliance program for transfer pricing only issues. So for sure, more developments will come on dispute avoidance in the future. Dispute resolution, these are topics that also will come more and more. So BEPS Action 14 has underlined the relevance of binding dispute resolution. Unfortunately, not all countries in the world like this, but we see that there are more countries, at least opening up the discussions on these topics. And in Europe, we have since 1 year, 2 years, the EU directive on dispute resolution, meaning that in Europe, when you reach this dispute that implies double taxation, then the competent authorities have to find an agreement within a couple of years. Otherwise, it will start binding dispute resolution mechanism. In some cases, it's called arbitration. I don't like to call it arbitration because arbitration in law is something different. In tax, arbitration is something completely different. So I call it binding dispute resolution. And this is something that every country in Europe has implemented, meaning that in the future, we will have more and more binding dispute resolution, at least in Europe. The OECD project on digitalization of the economy. This is an interesting project you all have heard about, whereby the OECD is trying to reshape the international tax world by means of working on a 2 pillars solution, where pillar 1 basically gives more taxing rights to the market jurisdictions. Pillar 2 basically is trying to implement more solutions to avoid that there are countries where you can have a lower level of taxation. So in my view, pillar 2 gives more taxing rights to the residence countries. Many people are saying transfer pricing will lose its relevance because of this new project of the OECD. The answer is absolutely wrong. The OECD is working on a solution in pillar 1 that does not touch much transfer pricing. Why? Because pillar 1 is trying to allocate more taxing rights to the market jurisdictions on top of the current taxing rights. So what you will have to do if this new proposal under Pillar 1 of the OECD takes place, and so if countries agree at the local level and at the international level to implement this solution, first of all, you will have to do your transfer pricing exercise as you do it now. And then after you have done that, on top of that, you might need to give some extra taxing, some extra taxes under Amount A to the market jurisdictions where you don't have any traditionally defined physical presence or permanent establishment. But to my knowledge, I'm not even sure that this Amount A is a corporate income tax in the traditional way that we know them. So transfer pricing will still be a relevant issue, even if and when this new proposal by the OECD will enter into effect. New technologies, probably this is one of the last slides that I have, and then I leave the floor to your questions. New technologies are something, of course, that are changing the world, and they are changing also the transfer pricing world. We have more and more softwares that are aiming at least helping with the compliance in transfer pricing. So, of course, at this stage, these softwares are not in the perfect status, but they are getting more and more useful to taxpayers and tax administrations. And you see here, I think in the future, artificial intelligence, robots, and even blockchain will help and will change the way that we deal with transfer pricing topics. I have an example that I've included at the end, but probably it's better to skip it and to go into the questions or considerations that you have. And then we go into the next presentation.
You can go ahead with the example, Rafa, don't worry.
Okay, wow. If you have questions, of course, feel free to interrupt me. Here I made an example that is taken from the OECD guidance after BEPS, but I have adapted for Mexico. So here you have ACO, a parent company in the US, and BICO that is situated in Mexico. Let's assume that Mexico is an agent for ACO's branded products in the Mexican market. Let's assume that BICO and ACO have concluded an agency agreement in order for BICO to basically provide agency services in Mexico. So try to find potential buyers in Mexico of the product manufactured and sold by ACO in the US. So the agency agreement is silent about marketing and advertising activities in Mexico. Now, if we find out during our analysis that based on the functions, assets, and risks of BICO, BICO has launched an intensive media campaign in Mexico in order to develop brand awareness. So let's imagine that people in Mexico don't know much about these products that the Mexican subsidiary is selling, and the Mexican subsidiary has entered into an intensive media campaign in Mexico, maybe involving a great football star in Mexico and so forth. Now, the campaign represents a significant investment for BICO. The question that we have here is, what should we do from a transfer pricing perspective in this situation? What can the Mexican tax administrations do, and whether they can complain about something. We have an agency fee, we have an agency agreement, an agency fee from ACO to BICO. The agency agreement doesn't say anything about this marketing campaign, and the agency fee covers only the agency functions of BICO, so does not cover any extra marketing activities. I don't know if the facts of the case are clear. Now, if we look at the solution of this case, we might have two different scenarios. So traditionally, looking at the contractual arrangements, this is what we were doing before BEPS. We're basically looking at the contractual arrangements. There is a contract of services, agency services. There is an agency fee. Let's make sure that the agency fee is at arm's length, is basically within, in the results, within the interquartile range, so it's remunerating the Mexican company for what is written in the contract, and that's it. This was mainly the situation before BEPS. Now, after BEPS, what will change is that the tax administration in Mexico can not only accept the contract as it has been drafted by the taxpayers, but it can also imagine that there are extra functions performed by Mexico, by the Mexican entity, that have not been included in the contract, but that does not mean that they cannot assess extra profits in Mexico. Now, how much of those extra profits can the Mexican tax administration assess? And as I said, there are two scenarios. Under the first scenario, if the entity in Mexico is performing those marketing activities at its own risks, with its own people, maybe the Mexican subsidiary has quite a good marketing department in Mexico, where the marketing campaign is conceived by those people. They put a lot of efforts, and if the marketing campaign does not go well, then the losses are taken eventually by the company in Mexico. Then, even if we have an agency agreement here, we still can imagine that the Mexican entity is a full-fledged marketing entity, meaning that on top of the agency fee, the Mexican entity, the Mexican tax administration might ask to the Mexican entity for extra profits coming from the marketing developments in Mexico, the so-called residual profits coming from the marketing activities taking place in Mexico. But of course, if you take this position, then any loss from failure in the marketing campaign in Mexico should also stay with the company in Mexico. The other option that you have, the other solution that you might have to this case is to say, in Mexico, there are not too many people that understand about marketing. Everything is suggested by and ordered probably by the company in the US. All the marketing strategies are conceived in the US. And if something goes wrong with the media campaign in Mexico, the US will take the losses. What does this mean? That Mexico, the Mexican entity is simply a limited risk entity, that the residual profits will end up in the US. The Mexican entity will simply have a routine remuneration, and that any investment undertaken in Mexico by the Mexican entity should be refunded by the US company, by the US parent company. So as you can see, while before BEPS, this case was quite of an easy solution because it would just look at the contractual arrangements and focus on the remuneration of the Mexican entity based on the functions described in the contractual arrangements. Now, after BEPS, this will go beyond the contracts. The tax administrations will be able to look at what is actually happening in reality based on factors, assets, and risks of ACO and BICO, and will make assessments of the profits of the Mexican entity based on what is actually happening in reality and not limited to the contractual arrangements. So more and more discussions will happen in the future on these topics. So this is it from my side, but if you have questions on this or what I've presented before, I'm here, happy to answer.
Yes, about the, I will take advantage that I control the microphone, so I would like to make the first question. About this case that you just present to us, how this new approach that the OECD is making is being held by the courts? Because seems like countries like Mexico that are more like civil law countries, even if they have now a substance over form rules, we have the tendency to protect the contracts and they will that the ACO and BICO will put in their contract. So how are these decisions made by that administrations being defended, or are they still successful in front of courts?
Mm-hmm. So the contractual arrangements, when they don't reflect the reality of the transaction, they are getting more and more under discussion. And these are discussions they are going also in front of courts. Of course, in common law countries, the US, the UK, Australia, you see courts challenging a lot those type of contracts where they don't reflect the conduct or the reality of the transaction. But when it comes to transfer pricing, it's not that the tax administration changes the contract. The tax administration cannot change the contract. It will still retain what is written in the contract, but the tax administration can change the profitability out of the real transaction, out of the reality of the transaction. So even that the reality of the transaction is not described in the contract, the tax administration can change the profitability connected to that. So that's why this is an issue not only of common law countries, but also for civil law countries.
Okay, thank you very much. If you want, we can make a couple of questions more. I don't know if Marisol has a question too.
No, and according to the TP guidelines, to the OECD TP guidelines, that's why it's very important to delineate the transaction, so you can be aware of what the transaction is really, and nevertheless what the contract says.
Absolutely, absolutely. This is something coming more. Yeah.
We have an anonymous question here for you, Professor Petrucci. Says, as you told us, transfer pricing is changing from economic to legal matters. In that scenario, there is a huge problem finding comparables in financial transactions and intangibles. My question is how to deal with such problems, since most tax administrations will not accept CUP or MNT methods.
Yes, so the discussions on intangibles are becoming more and more frequent, as I mentioned before, and these are complex topics that traditionally were not dealt with, and now they are dealt with. When it comes to the economic analysis, I think this is where the question is going to. The CAP method is something that is quite often used in cases of intangibles because there are some databases available, sourcing the data from the US mostly. And so there are more and more public information on this. However, these are quite expensive databases and not all tax administrations can afford them. So when it is about intangibles, the methodologies that will more and more be used in the future will be either the TNMM, when there is one party developing all the intangibles and the other one not doing much. So you give with the TNMM the residual profit to the complex party, or profit split when you see two entities that are developing together. And the OECD has introduced this definition of DEMPI, development, enhancement, maintenance, protection, and exploitation of intangibles, to look at when we have to do this exercise. So in the future, in the case of intangibles, we'll use more and more TNMM and profit split. When it is about TNMM, hopefully more guidance also coming from the OECD work on Pillar 1 will provide some safe harbors where you can assess the profitability of the routine entities by means of safe harbors. And this is something I understand you are quite familiar in Mexico with the maquiladora regimes. Profit split is a little bit more complex. Unfortunately, you cannot do much profit split without having access to data and to an understanding of how third parties would split profits in the real world. But this is something that we will have to fix in the future when it comes to intangibles. So yeah. For sure yes, we can try to find some easy solutions when it comes to transfer pricing, but when we deal with complex topics, easy solutions don't work much. So we have to learn how to deal with uneasy solutions here. Yeah.
I see. Before going to the next speaker, there's a question from Alejandro Calderon. He says, and he refers to the example, if the Mexican company is paying royalties and also developing some DMP functions, the solution will be to reduce the royalty payment or putting an income in the Mexican entity.
So at the end of the day, what is really important is that the Mexican entity has, at the end of the year, a profit that is reflecting the functions that it's actually doing. So either is having this big marketing department, and so it should have residual profits, or it doesn't have anyone that knows how to deal with marketing, and so it should have only the routine profits. The way that you assign this profitability to the Mexican entity, it's something that transfer pricing doesn't give you a specific answer all the time. So it can be by, if the Mexican entity is paying royalties, then of course, in this case, you should question if the Mexican entity is a limited risk entity, you should question whether that entity should pay royalties at all. If the Mexican entity is a full-fledged entity, then of course you keep having royalty payments, but you should reduce them. Another way to compensate the Mexican entity could be by simply invoicing from Mexico to ACO for the marketing services or other type of compensation. What transfer pricing really looks at is that you have corporate income tax profits that reflect the reality of the transaction, specifically looking at functions, assets, and risks. Then, if you compensate it with royalties or with services, this is something that depends also on other legal matters, and that impacts other legal matters such as withholding taxes, for example, from Mexico to the US.
Thank you very much for your answer. Thank you very much for your presentation. The anonymous attendee, he is just explaining a little bit more. He says in Peru, MNT method is used as a default method. It means if CUP or other methods do not apply, we could use it. The issue is that it could increase our risk in future tax disputes. Thank you very much. These are the we have so far. As I said, we have a section for questions and answers later. If there are more questions coming up, please just keep writing them here. And now, thank you very much, Professor Petrucci. Now we leave the floor.
Stop sharing my slides. Okay. Yeah.
And please go ahead, Professor. Thank you.
Thank you very much.
Can you see my screen now?
We see, yes.
Okay. Okay. Well, good morning, good evening, and good afternoon. Thank you, Cesar, and thank you. Thanks to the Foundation Aguirre Azuela Chavez Jauregui Pro Derechos Humanos for the invitation. I'm honored of being here as a representative of the Asociación Iberoamericana de Especialistas en Precios de Transferencia to share with you about transfer pricing developments in Mexico. I don't know what happened with my screen. Okay. Well, transfer pricing in Mexico rules began in 1992, almost 30 years ago, notwithstanding that that Mexico was the first country in Latin America region that broke the TP rules in the domestic law. It is still a young practice. But Mexico, as an OECD member, has been the hardworking student. I used to say that Mexico is the hardworking student of the class in the region, because to a large extent, the guidelines and recommendations of the OECD have been adopted as soon as they are issued, but sometimes the basis for their application do not exist yet. Such as the case of the BEPS action plan, which in Mexican tax reform for 2014, BEPS actions were considered, but we didn't know what was meant to be BEPS, but we were aligned since then. Transfer pricing rules in Mexico are changing for the next year with the recently tax reform approved for the 2022 tax year. Until 2021, Mexican taxpayers were obliged to prepare transfer pricing documentation for foreign related parties. And in the case of domestic transactions, the obligation was only to apply a method to determine the prices for transactions between related parties. Now, for 2022, the TP documentation is mandatory for both domestic and foreign related parties. And it must comply with all the formal requirements, such as identification of the related parties, the comparability analysis. Note that the financial information of comparable companies must be contemporaneous. I mean, of the same year of the tested parties tax year subject to test. The functional analysis now must be with more detail, because new rules state that the functional analysis must provide detailed information from the local taxpayer and the related parties. So the functional analysis must be per related party and per kind of transaction. The information and documentation of the transactions, the transfer pricing method applied. In Mexico, there are 6 methods. And according to the best method rule and a description of the adjustments performed, contractual terms and conditions, business strategies, and economic circumstances. Only if the business or cycle of the product takes more than 1 year, the use of multiple year data of comparable companies' information must be justified. If not, the comparable information should correspond only to the tax year being examined and not an average of 3 years as usual by the TP practitioners. So TP documentation is mandatory for transactions with domestic related parties, foreign related parties, and also with individuals. We have an informative tax return or Appendix 9, which until 2021, it was for transactions with foreign related parties. And for the next year, it will be for domestic transactions too. Another change is that the interquartile method is the only one method authorized to determine comparability ranges, not any other method. What else? Okay. TP documentation. Mexico is aligned with BEPS, with actions 8, 9, 10, and 13. So master file, local file, and CBC report are mandatory in Mexico. There are thresholds for each one of these. And the date for compliance, master file is December 31st, local file with the reform is May 15th, and country by country report, December 31st. Now let's talk about maquilas. Maquila is a special tax regime through the taxpayer has first the benefit of a statutory permanent establishment exemption, which means that the principal of the maquiladora non-resident in Mexico would not be deemed to have a permanent establishment in Mexico in connection with the maquila operation. And second, at the same time, the maquila complies with transfer pricing obligations. Until 2014, the maquila had 3 options to comply with transfer pricing rules, which were transfer pricing study, safe harbor, and APA. From the 2014 tax year, the maquila has 2 options only, which are safe harbor and APA. Transfer pricing study was eliminated for this sector. And well, the safe harbor is consists in determining the net taxable income highest between 6.9% of the net value of all assets used by the maquiladora in the maquila activities, including those assets owned by foreign related parties, or 6.5% of the costs and expenses incurred in the performance of the maquila activity. But with that change in law, the Mexican Tax Authority negotiated with the IRS, and in 2016, they created a mechanism to resolve the APA requests originated from the tax reform, because typically the safe harbor produces a higher tax income. And as a result of such negotiation, the IRS and the SAT created the Qualified Maquiladora Approach Agreement, or QMA, which is an efficient tool to determine a taxable income based on the type of maquila, if it is labor intensive or capital intensive, and taking into account key aspects of the and variables of the maquiladora. So this mechanism was safe because it was negotiated between the tax authorities and with no double taxation effects. The first batch of APA, around 700, was requested about for the 2014 through 2019 tax period. And the second is in progress, but some maquiladoras and their advisors tried to modify or adjust some variables of the methodology, arguing that each one of the maquilas were different or specials from the other maquilas, which derived that from the next year, the 2022 tax year, the APA alternative is not an option anymore for the maquiladoras, and the only one is the safe harbor. Well, my recommendation is that those maquiladoras, depending on the circumstances for which an APA could be better than a safe harbor, should submit an APA request to the Mexican tax authority before the end of 2021 tax year, taking into consideration that in this year, the APA is still a legal option. And according to law, the proceedings began before the new tax law comes into force, will be addressed and resolved according to the law in force until December 31st of this year. So you are in time still. And the APA request must strictly adhere with the QMA approach.
Sorry, there is a question about the previous slide.
Yeah.
Anonymous attendee says, if you could explain again the safe harbor in Mexico, that he saw an MOCG of 65%.
Okay, well, safe harbor is, you have to determine the net taxable income highest between the 6.9% of the net value of all assets used by the maquiladora in the maquila activities, including the assets owned by the foreign related parties, or 6.5% of all of the costs and expenses incurred in the performance of the maquila activity. The higher is the percentage which you will use to determine the net taxable income of the maquila.
Thank you. And also another question about the presentation. What do you mean with interquartile method? It means that in Mexico does not apply CUP, RPM, or TNM, or other methods?
No. Interquartile method is the method to determine the comparability ranges. Once you applied one of the other methods, the CUP, the TNM, the MPR, with the comparable information of the companies you selected, then you must create a comparability range, and the method authorized by the tax authority here in Mexico for that effect is the interquartile method.
Thank you.
No more questions? Okay. Okay. Another interesting reform is about the use of secret comparables. When the tax authority is auditing a taxpayer for its transactions with related parties, the taxpayer may appoint a maximum of 2 representatives through written notice to have access to the confidential information provided from independent third parties regarding comparable operations. And the access to this information will only be for the taxpayer to amend its situation or challenge the resolution determined by the tax credit. So the taxpayer must sign a confidentiality document or if the taxpayer doesn't designate any representative, it can go by itself with the tax authority and then realize this process. The taxpayer on its or its representative may not steal or photocopy or photograph or transcribe any other way obtain information, even by digital means. The taxpayer only can take notes from the information that the tax authority provides to him, and the information of the comparables is information in possession of the tax authority and that it receives from taxpayers through the tax returns or the electronic accounting, among other information that the tax authority receives. So these are known here in Mexico as the secret comparables. We were aware that this practice was used by the tax authority, but it wasn't in law. For the next year, it's now in the law. I don't know what happened with my slides. Well, this is all that I had to share with you. Our tax administration is willing to get more and more taxes from the same taxpayers. So I think this tax reform is reflecting that. I don't know if you have any questions.
Thank you very much, Professor. Yes, we have a couple of questions, and let's go ahead. Frank Salazar says, it seems that Mexico transfer pricing is in accordance with the OECD guidelines. Could you explain to us if there is any difference since the Mexican's perspective? Professor Marisol? We're having.
I'm sorry, there was a problem with my audio. Can you
repeat the question? Yes, sure.
Yeah, please.
It seems that Mexico transfer pricing is in accordance with the OECD guidelines. Could you explain to us if there is any difference from the Mexican perspective?
No, the Mexico transfer pricing rules are based on the transfer pricing guidelines of the OECD, even though in our Mexican law, there's a reference to the transfer pricing guidelines to interpretation. So Mexican legislation is based on OECD guidelines.
Okay, thank you very much. Let me ask a question too. So Professor Petrucci was explaining to us that there is a trend, at least in Europe, to to take to the courts the transfer pricing cases. Have you seen this kind of trend too in the Mexican scenario? Do you see transfer pricing cases going to tax courts or to the Supreme Court more often than they used to be?
Yeah, and because of the tax authorities willing to get more taxes, the taxpayers are trying to
And he was saying that in Europe, is 49% of cases are more successful for the tax administration and 45 for the taxpayer. What's the experience in Mexico? The Supreme Court doesn't seem to be very much taxpayer friendly, but in transfer pricing, is there any difference? Or is...
Well, the actual tax administration says that they want to negotiate with the taxpayer before go to the court. That's why they say they're trying to do. And there's a new mechanism that SAT is negotiating with the OECD, the International Compliance Assurance Program, which is trying to prevent that the taxpayers go to the court. So it is something like taxpayer negotiates with the tax administration.
I see. Thank you. We have another question here also for you, Professor Petrucci. You were mentioning that there is a mandatory dispute resolution in the European Union. Are these mandatory dispute resolutions mandatory just for transactions between EU members or also with other European countries or also with third countries?
So this is a European directive, as I mentioned, but it covers a larger scope than just Europe, in the sense that it applies also to permanent establishments, I think, of not European companies operating in Europe. So I'm not 100% sure right now about this, but as far as I recall, this covers also cases of permanent establishments in Europe of not European entities. So you cannot apply typically to cases between Italy and Mexico if the Mexican entity does not have a permanent establishment in Europe. But if the Mexican entity does have a permanent establishment in Europe, then you can apply it between the country, the Italy, and the country where the permanent establishment is located.
Okay, thank you very much for your answer. And let me see, we have another question here. I think we are good. In the case of when we were talking about the transfer pricing judicialization of cases in Mexico, Professor Orgel mentioned something really important is happening in our judicial system, that we are trying to use alternative methods of resolution to accelerate, to speed up the solution of cases. But when you're mentioning that you are having a lot of cases now in the courts, do they have also a previous conciliation stage or something like that to prevent going to the actual conflict before the court? To you, Professor Petrucci.
That's a question. That's a question for me. Okay.
Yeah. So if because in Mexico we are having a conciliation, we are having an increase in alternative methods of resolution. So before the case before the court, are you those for transfer pricing too in the European Union?
Well, of course, this is true for Europe, but for also other countries outside Europe, that you tend to try to find a settlement before going to court between taxpayers and tax administrations. So especially in transfer pricing cases, especially in the past, taxpayers, tax administrations were avoiding at any cost to go to courts, because that would, in many cases, also create a precedence. And in transfer pricing, you were not 100% sure whether the economic aspects would have been also understood by the courts. Now it seems that instead this is not the case in many instances, as you've seen, that there is more and more court cases coming up. So, but yes, there are some settlements available in Europe before going to courts.
Thank you very much for your answer. And actually, I think we don't have any more questions, and we covered already the time this event was scheduled for. So I thank you very much, both of you, for your kind presentation, for sharing your knowledge and your experience with us. Thank you for accepting our invitation. And we just want to share with our audience that this is our first approach to a project that we want to join together. La Fundación Aguirre Anguiano, Azuela, Chávez, Jauregui Pro Derechos Humanos, la revista Tiempo de Derechos, and the Aula Tiempo de Derechos, the Asociación Iberoamericana de Especialistas en Precios de Transferencia, and of course the BU Transfer Pricing Center. That is, I don't know if you are very aware of this, but Dr. Rafael Petrucci is head of the, we were just talking about that before the presentation, is head of the only transfer pricing center in the world. And in the last 7 years, he has developed some courses that they are increasing and increasing, courses that cover basic aspects of transfer pricing. They cover advanced topics of transfer pricing, and now they are divided in 3 different courses that he and professors that he has called from around the world share in Vienna. So the project that we are trying to bring to you guys is to have the possibility for the Mexican auditorium and Latin American auditorium to have the chance to attend these courses with Professor Petrucci. We are working on that. Just stay tuned with our social media, with our Twitter, with our websites, because likely at the beginning of the year, you will have some news about how can you register for these courses without the amazing experience of going to Vienna, but maybe making more possible for you guys to take these extremely advanced courses of transfer pricing. Thank you very much, Professor Petrucci. It's an honor for us to have you with us, and we hope it's just the first of many, many times. Thank you, Professor Orejel, too. For us, it's a pleasure to work with the Asociación Iberoamericana de Especialistas en Precios de Transferencia, and we also hope to have you more often here with us. Thank you, Dr. Rafael Estrada, for joining us from the Revista Tiempo de Derechos and for making possible this event to happen too. And thank you guys for attending too. I know it's a difficult time and a difficult language, but thank you very much for being here with us, and you will receive your diploma soon in your email. So thank you very much, everybody. Professor Petrucci, Professor
Thank you.
Dr. Estrada.
Thank you.
Bye-bye.
Have a nice afternoon. Bye.